Welcome to today's Registrant Outreach webinar on CRM2 reporting to clients and on Portfolio Manager IIROC Dealer Service Arrangements. My name is Trevor Walls. I'm a Senior Accountant in the Compliance and Registrant Regulation Branch. I led the CSA working group that drafted the staff notice on PM Dealer Service Arrangements. I'm joined today by Andrea Magisano. Andrea is legal counsel also in the Compliance and Registrant Regulation Branch, and she was one of the staff involved with the implementation of the CRM2 requirements. Before we begin our presentation, here's our standard disclaimer. I won't go through it, as you may read it on your own if you choose. Here's the agenda for today. First, Andrea will discuss CRM2 reporting to clients. Then I'll discuss the recently published CSA Staff Notice, which provides guidance for PMs that have custody and trading service arrangements with IIROC dealers. Now, over to Andrea.
The report on charges and other compensation, and the investment performance report. I'll also briefly be going over the requirements as they apply to EMDs. We understand that most of you are already operational and have already implemented these requirements, so this presentation may act as a refresher for you. We also do continue to receive questions from firms on CRM2, so we've tried to address these questions during this presentation. Some of you may have very technical questions because of the nature of CRM2. Of course, feel free to ask them. If we can't give you an answer today, we'll take it offline and get back to you. So the CRM2 amendments were amendments to Part 14 of 31103. They introduced new requirements for reporting to clients on the content of their accounts, the cost of the services you provide them, and the performance of their investments. The amendments came into effect on July 15, 2013, and have been phased in over a 3-year period. All transition periods are now over, and so firms are required to comply with all of the new rules. The final amendments that came into effect are the 2 new annual reports. Some of you may have already sent these to your clients in January. However, as we'll get to, firms can send them as late as summer 2017. So I'd like to go through the resources first because the current CRM2 requirements can be found in a few different places. As I mentioned, the rules are in 31103. In May 2015, we granted temporary relief from certain CRM2 requirements. In April 2016, the CSA published an FAQ that replaced 2 previously published staff notices, and they are listed in the introduction to the FAQ. Last summer, we published proposed amendments to 31103 that incorporate the temporary relief granted in May 2015 and much of the guidance in the FAQ. The comment period for these proposed amendments closed in October, and we're still considering the comments that we received. So the rules for client statements are now split between 3 sections in 31103, 1414, 1414.1, and 1414.2, under the headings Account Statements, Additional Statements, and Security Position Cost Information. Today I'll be using the term Client Statements to cover the requirements from all 3 of these sections. Firms are generally required to send client statements quarterly, and if the client requests, monthly. So when a firm has to provide transaction information is straightforward. If the firm has made a transaction for the client during the period covered by the statement has to include transaction information. When a firm has to provide account holdings information requires more of an analysis. If your firm holds client securities, your client statements must include the information in subsection 1414.5. And this will likely not be the case for many of you who are registered as PMs or EMDs. If your firm does not hold client securities, your client statements might still need to include account holdings information. These requirements are found in subsection 1414.1 sub 2, and this will be much more typical for PMs and EMDs. If you're required to include account holdings information in your client statements, you will also be required to show the cost of the security position, and these requirements are found in section 1414.2. For portfolio managers, we're typically seeing all of this information being sent to clients in one statement, with a transactional information section and an account holdings information section. For EMDs, we're seeing different types of statements depending on the firm's operating model. So a quick note about the delivery of client statements before we get into the details. Firm must provide clients with a client statement for each of their accounts. Consolidated statements can only be sent as supplementary information. Even if a client asks to only receive consolidated statements, the rule still requires you to send a statement for each account. There are no prescribed forms for the statements, only prescribed information. And throughout the rule, you'll see that there are notifications that you are required to include in your client statements. You're only required to use the notifications in substantially the form provided in the rule, meaning that you can revise them to reflect your actual situation. So now I'll go through each component of the client statements in detail, starting with the transaction information. Again, if you made a transaction for your client during the period covered by the report, so during the quarter or the month, you have to include certain information about the transaction in the client statement. This information includes the date of the transaction, the type of transaction, so whether it's a purchase, sale, transfer, dividend, or interest payment, for example, the name of the security, the number of securities purchased, sold, or transferred, the price per security, and the total value of the transaction. Also note that a dealer has to send this information at the end of a month if the transaction occurred during the month and the dealer holds the client's security. And we're going to go over what that means later. Here we have a very simple example of what the transaction information section of your client statement might look like. After the transaction component of the statement, the next component is the account position or holdings information. Whether a firm has to provide account holdings information under section 1414 or 1414.1 depends on a number of factors, including whether the firm holds the client's securities or whether another party holds the client's securities. A firm holds securities if it is the registered owner of the security on the books of the issuer as a nominee on behalf of the client. It will also hold securities if it has physical possession of a certificate evidencing ownership of the security, for example, a share certificate. A security is considered to be held by another party if any of the following apply. The other party is the registered owner of the security as a nominee on behalf of the client. Ownership of the security is recorded on the books of the issuer in the client's name, or the other party, which may be the client, has physical possession of a share certificate, a certificate evidencing ownership of the security. So IIROC and MFDA firms frequently hold securities in nominee name for their clients, but in the PM and EMD space, we typically see securities being held by another party, for example, in client name. So if you find that your firm holds client securities, this is the account holdings information you would be required to send to your clients. Again, PMs and EMDs do not typically hold client securities, so this section will likely not apply to you. However, there are a few circumstances where an EMD may hold client assets, for example, with certain mortgage-related investments. If your firm does not hold client securities, you might still need to send account holdings information to your client under section 1414.1. In the rule, this section is called the additional statement. However, you're not required to call this part of the statement the additional statement. In reviews, we are generally seeing this information combined with the transaction information making up one client statement. You're required to send the account holdings information set out in this section if your firm does not hold client securities. For example, the securities are held in client name or with a custodian, and one or more of the following apply. The firm has trading authority over the account, and this will catch 99% of PMs. The firm receives continuing payments related to the security, for example, a trailing commission, and this will catch mutual fund dealers and some EMDs who are receiving some sort of continuing payments. The security is issued by a scholarship plan, a mutual fund, or a labored-sponsored investment fund, and the firm is the dealer or advisor of record. And this will catch EMDs that trade in units of mutual funds. Remember, this refers to the legal definition of mutual fund and not just funds issued under a prospectus. So some pooled funds are going to be included here. For delivery, this information must be delivered to the client quarterly or monthly if requested by a client. It can be delivered in 3 ways. Combined with the transaction information in one document, and this is what we're typically seeing in compliance reviews, as a separate document accompanying the transaction information, or as a separate document delivered within 10 calendar days of the transaction information. For account holdings information where the firm does not hold client securities, there is a carve-out for permitted clients that are not individuals. So if you've determined that you are required to comply with section 1414.1, this is the account holdings information you have to send. This is the same information that needs to be sent by firms that hold client securities, with the addition of F, disclosure about the party that holds or controls each security and a description of the way it's held. This disclosure must provide sufficient information for the client to be able to identify the party that holds their securities. If a custodian is used, for example, you need to name the custodian. Right now, PMs and EMDs are exempt from providing the information in G, whether the securities are eligible for coverage under an investor protection fund like CIPF or IPC. If the proposed amendments are approved, PMs and EMDs will not have to provide this information if the person or company who holds the securities is disclosing this information in their client statements. So, if you're a typical PM and you have trading authority over a client's account with an IIROC dealer, then you won't have to provide this information because the IIROC dealer will be providing it. Here is an example of what the account holdings information section of your client statement might look like. It includes the name and quantity of each security in the account, the market value of each security, the total market value of each security position, any cash balance, the total value of all cash and securities. The sample includes example disclosures about the party that holds or controls each security and the way it's held, and the definition of book cost. You'll see that there are no disclosures about whether the securities are eligible for CIPF or IPC coverage because the custodian is providing this information, and no securities are identified as being subject to a deferred sales charge. So when you're determining market value for the account holdings, there's now a prescribed methodology that you have to follow, and it's in section 1411.1. As we did before, we expect you to have a valuation policy outlining your firm's procedures. The prescribed methodology is as follows. For securities of an investment fund that is not listed on an exchange, use NAV provided by the investment fund manager of the fund. For securities listed on an exchange, like your typical exchange-traded equity, use the last bid or ask price. And many firms are using closing price to value securities listed on an exchange. We've stated in the FAQ published last April that using closing price may be acceptable where there is an active market for a security. If you use closing price, you must be able to demonstrate that the last bid and ask prices and the closing price are materially the same. To do this, we expect you to do a periodic assessment. We would also expect to see policies and procedures for how the firm does this assessment. So where the security is not listed on an exchange, the rules set out a hierarchy to follow, and this hierarchy is based on IFRS principles. If no reliable price is quoted on a marketplace, the firm should use published market reports or interdealer quotes. If a firm is unable to determine a market value using market information, we will accept a valuation policy that includes procedures that assess the reliability of any valuation inputs and assumptions. If available, Valuation inputs and assumptions should be based on observable market data or inputs, such as market prices or yield rates for comparable securities. If observable inputs are not available, valuation can be based on unobservable inputs and assumptions. And again, these are IFRS concepts. If a firm reasonably believes that it cannot determine market value after following this hierarchy, the market value must be reported on the client statement as not determinable and excluded from total market value calculations. So if you use observable inputs or unobservable inputs and assumptions to determine market value, so C or D from the previous slide, the client statements must include a notification similar to the following. There is no active market for this security, so we have estimated its market value. If market value cannot be determined, you're required to exclude the market value, exclude it from market value calculations in the client statements and indicate that market value is not determinable. And if you recall, we did this on our sample client statement a few slides ago. Concluding that you cannot determine the market value of a security is not the same as concluding that the security has a market value of 0. However, we would expect that if a market value of a security cannot be determined for a prolonged period of time, that may be an indication that the market value should now be 0. In the FAQ, we've set out a number of factors that could be considered when determining when the market value of a security is not determinable. For example, if the security is illiquid or if there's little or no issuer data available. If the market value of a security subsequently becomes determinable, the firm must begin to report it again. So back to client statements. The third component of the client statement requirements is the security position cost information. If a firm is required to deliver account holdings to a client, it will also be required to provide the security position cost. Position cost information provides investors with a comparison to the market value for each security position they have open. The goal is for investors to be able to compare what they actually paid with the security's current market value. To show position cost, firms can use either book cost or original cost, and these terms are defined in Section 1.1 of 31103. And the definition of whichever method you choose needs to be disclosed in the client statements. We're seeing many firms use the term book value for position cost, and this is okay as long as you explain that the book value is either book cost or original cost, and as long as you include the correct definition. As we said in the FAQ, the position cost reporting requirements are not intended to be tax cost. Firms cannot adjust position cost to align it with tax cost. If a firm also wishes to provide tax cost information, it may do so in addition to the position cost as long as the differences are made clear to the client. With respect to the delivery requirements, they're also flexible. Security position cost information can be sent combined in a statement with the account holdings information, and this is what we're typically seeing in reviews, in a separate statement accompanying the account holdings information, or in a separate statement within 10 calendar days of the account holdings information. However, if you do choose this method, market value information must also be included so that the investor can make a comparison. And as with account position information, there's a carve out for permitted clients that are not individuals. Position cost reporting requirements differ depending on when the security was opened. The companion policy to 31103 explains that a security position is opened when the firm that's providing the statement to the client first acquires or holds securities for that client. It can also be when a PM first obtains trading authority over a security. Examples are when the firm purchases a security for a client's account or when a client transfers a security to its account at the firm. So if a firm purchases a security for a client's account on February 21st, 2017, the security position was opened on that date. If a client transfers a security to its account at a firm on December 1st, 2017, the security position was opened on that date. These are the rules that apply if a security position is opened on or after July 15th, 2015. If you acquired a security directly for clients on or after July 15th, 2015, You're required to disclose the cost because you'll know it. If a security position was transferred in from another firm and you know the cost, you can use it, but you don't have to. You can also use the market value on the date it was transferred, and this would allow you to track the value of the security since you started to manage the accounts. It's important to note that if you use market value instead of cost, you have to include a disclosure in the statement that explains this. For positions opened before July 15th, 2015, you can use the cost of the security if you know it, the market value as of December 31st, 2015, or the market value as of a date that's earlier than December 31st, 2015, if it is reasonable for you to choose that date based on the availability and accuracy of the information you have. Again, if you use market value instead of cost, you have to include disclosure that explains this in the statement. Normally, if you choose to use a date before December 31st, 2015, we would expect you to use that same date for all clients. However, we understand that there are situations where you would have different data for different groups of clients and would therefore want to use different dates. Examples of where it might be reasonable to use a date before December 31st, 2015 for some but not all clients include where the firm uses the same dates for all clients that were transferred to a firm at the same time, or all clients on the same reporting system if the firm has more than one reporting system. As I mentioned in the previous two slides, if you report a security position using market value instead of cost, you have to include a disclosure in the statement that explains this. And here's an example of a disclosure that explains that a firm has used market value for transferred positions. In the first part of the disclosure, the firm has provided the definition of book cost. In the second part, the firm explains that they are using market value information instead of cost. Of course, any disclosure that you use will have to reflect your specific situation. When a security position is built up with successive purchases or transfers, the rule also gives you some flexibility. Book or original costs might be available for some securities but not others. So you can report the cost of the security position using a combination of both book or original cost for positions opened after July 15, 2015, and market value for positions opened before July 15, 2015. You can also report the cost of the security position using a single average number or multiple numbers. And whatever method you choose, make sure that you give your clients adequate disclosure to avoid confusion. Here's an example of a disclosure for successive transactions, and as I said before, any disclosure you use will have to reflect your specific situation. So one last slide about client statements. There is a requirement in the rule for IFMs to send security holder statements to an orphaned account, and this is one without a dealer of record, and this is not a new requirement. The situation usually arises in temporary and very limited circumstances. What is new is that the IFM is now required to send more information, including transaction, account holdings, and position cost information on an annual basis. And I also wanted to add that scholarship plan dealers are also required to send annual statements that provide transaction and account holdings information. So now I'm going to move on to the two new annual reports, the report on charges and other compensation and the investment performance report. Some of you may have just sent these reports to your clients for the first time. The report on charges and other compensation shows in dollars what the firm was paid for the products and services it provided to its clients, and also any other financial incentives it may have received in connection with the client's accounts. There is no prescribed form for the report, but it must include information on the following: operating charges, transaction charges, payments received from issuers or other registrants, trailing commissions, and information regarding debt security transactions. Operating charge and transaction charge are defined in Section 1.1 of 31103 and only include charges paid to a firm by a client. There is a discussion on operating and transaction charges in the companion policy to 31103. With respect to payments received by issuers or other registrants, this does not include trailing commissions. Examples of these types of payments are referral fees or success fees. Trailing commissions are required to be disclosed as a separate item. If a firm receives trailing commissions, the report also has to include a notification explaining what trailing commissions are. The notification has to be substantially similar to the one provided in the rule. And there is a sample report in the companion policy to 31103 that we encourage you to use as guidance. As you're probably aware, the report on charges and other compensation does not currently extend to embedded fees paid to issuers, such as mutual fund management fees or non-cash incentives that may be paid to the firm or its representatives for the sale of certain products. When we published the proposed amendments to the rule last July, we asked for comments on these two issues. We are currently reviewing the comments that we received. The second report that's required to be delivered to clients annually is the investment performance report. This report must cover the same 12-month period as the report on charges and other compensation. It must include the market value of all cash and securities in the client's account at the beginning and end of the 12-month period, the market value of all withdrawals on transfers from the account and all deposits and transfers into the account over the year and since the account was opened, the change in market value of the account over the year and since the account was opened, and annualized total percentage returns for 1, 3, 5, 10, and 10 years, and since the account was opened, using a money-weighted return method. Note that the change in market value must include components such as income and distributions, realized and unrealized capital gains or losses, the effect of operating charges and transaction charges, if these are deducted directly from the account. Firms can show the change in market value as a single amount or can choose to break it out into its components to provide more detail to clients. And as with the report on charges and other compensation, there is a sample investment performance report in the companion policy to 31103 that we encourage you to use as guidance. So as discussed on the previous slide, firms are required to show certain information in the investment performance report since the opening of the client's account. The rule does include flexibility for client accounts that were opened before July 15, 2015. If a firm delivered its first investment performance report to clients this past January, covering the 2016 calendar year, it can use January 1, 2016 instead of the actual account opening date. If a firm will send its report later this year covering another 12-month period, it can use July 15, 2015. Firms can also choose an earlier date if the earlier date is reasonable based on the availability and accuracy of the firm's recorded historical market value information. And as with position cost, we expect that firms will normally use the same deemed account opening date for all of its clients. However, we realize that there may be situations where a firm may want to use different dates for different groups of clients. Again, examples of circumstances under which we would consider it to be reasonable for a firm to choose a date earlier than July 15, 2015 or January 1, 2016 for some but not all clients include when a firm uses that same date for all clients that were transferred to a firm at the same time or all clients that are on the same reporting system of the firm, if the firm has more than one reporting system. As I mentioned, firms are now required to provide annualized total percentage returns using a money-weighted rate of return calculation method. No specific formula is prescribed, but if you're required to use a method that is generally, but you are required to use a method that is generally accepted in the securities industry. Approximation methods such as modified DEETs are not acceptable. You are also required to include the definition of total percentage return from section 1.1 of the rule and an explanation of what the calculation method takes into account. For example, you could explain that under a money-weighted return method, decisions the client made about deposits and withdrawals to and from the client's account have affected the returns. We do not expect firms to include a formula or an exhaustive list. And if you would like, you can also provide percentage returns using a time-weighted method, in addition to returns using a money-weighted method. But if you do, we expect you to explain the difference between the two in plain language. A few additional comments about the two annual reports before we move on. They have to cover the same 12-month period. They can be delivered together with the client statements, accompanying the client statements, or within 10 calendar days of the client statements. And firms don't have to send they don't have to send the two annual statements to permitted clients that are not individuals. In addition, firms don't have to send the investment performance reports if an account has been open for less than 12 months, or if the account is with a dealer who only executes trades as directed by the client's advisor. Unlike the account statements, firms can consolidate more than one of a client's accounts into a single report if the firm has the client's written consent. This means one report on charges and other compensation and one investment performance report covering more than one account. And to recap, if a firm chooses to report on a calendar year basis, the first reports will have covered January 1st to December 31st, 2016, and will have been sent out this past month. If a firm chooses another 12 months, that 12-month period can end as late as July 14th, 2017, and the firm will send out the reports with the following client statements. So we often receive questions about the application of CRM2 to EMDs, so the next two slides address some of these points. CRM2 requirements are applicable to all dealers and advisors. Any differences will be the result of different operating models. So, for example, whether or not an EMD has to send account position information depends on whether it falls within the scope of Section 1414 or 1414.1 of 31103. An EMD would have to send account position information to a client if they hold client securities, for example, if they have physical possession of a share certificate, or if another party holds the client securities, but the EMD is the dealer of record and the securities are issued by a mutual fund, or if the EMD receives continuing payments related to the client's ownership of the security. As always, the transaction information will be required if there has been a transaction in the period. And if an EMD finds that it has to provide account position information, it will also have to provide security position cost information. With respect to the annual reports, if an EMD finds that it is required to deliver account position information to a client, it will also be required to deliver the two annual reports. Of course, if there are no charges or other compensations to be disclosed to the client, the firm does not have to send a nil report. Likewise, if a firm is not able to determine market value of any of the client's securities, it's not required to deliver the investment performance reports. And that's all for CRM2.
Okay, thanks, Andrea. Now, for the next part of the presentation, I'll cover CSA Staff Notice 31347, which provides new guidance for portfolio managers that have service arrangements with IIROC Dealer Members. The notice applies to firms registered as portfolio managers, or PMs for short, that have entered into these arrangements and complements the previous CRM2 reporting to clients discussion, as the notice includes our expectations for how a PM may satisfy its client statement delivery obligations when only the IIROC dealer sends the PM client a custody statement. And it also includes some expectations on a PM's annual investment performance reports to clients when a PM is not sending its own client statements. Now, here's an overview of what I'll be covering. First, I'll explain and give some background information on PM IIROC Dealer Service Arrangements, or PMDSAs for short. Then, I'll go over the key points in the staff notice. And then I'll discuss some other points to consider. For example, since the notice only deals with arrangements between a PM and an IIROC dealer, I'll provide our expectations on a PM's statement delivery obligations when it uses a financial institution custodian for its clients instead of an IIROC dealer member. Okay, so what are PMDSAs? They're arrangements between a CSA-regulated PM firm and an IIROC dealer member firm, where the dealer provides custody and trading services to the PM and its clients. And the dealer may also provide other services, such as assisting the PM with its client reporting. Now, typically under these arrangements, an investor engages a PM for investment management services, and at the same time, the PM helps the investor open a custody and trading account in his or her name at an IIROC dealer. The investor gives the PM discretionary trading authority over his or her account at the IIROC dealer. And the investor thus becomes a client of both the PM and the dealer. But the PM and dealer have different roles and responsibilities to the shared client, and thus different regulatory obligations. For example, the PM has the client-facing relationship and must thoroughly know the client and make suitable investment decisions for the client, and annually report investment performance, all under requirements in National Instrument 31-103. Meanwhile, the dealer will execute, clear, and settle trades in the client account based on instructions from the PM, and will safeguard the client's portfolio assets in its role as custodian, all under IIROC dealer member rules. But each of the PM and dealer have client record keeping and client statement preparation and delivery obligations to the shared client, under 31-103 for the PM or IIROC dealer member rules for the dealer. And both the PM and dealer also are to annually deliver a charges and other compensation report to the shared client. For example, the PM would report its investment management fees, and the dealer would report trading commissions and any custody fees. Now, in the past couple of decades, these arrangements have become more widespread. More than half of the 800 PM firms across Canada have these arrangements, and over 20 dealers provide these services to PMs. And the arrangements have changed over time. It used to be that the PM clients' accounts would be set up on an omnibus or no-names basis on the dealer's books. But now they are typically set up on a fully disclosed basis, meaning accounts are set up on the dealer's books separately for each client and in each client's name. This has the benefit of attracting CIPF coverage in the event of the insolvency of the dealer. However, it's raised some concerns, both from CSA and IIROC staff. Key concerns include some PMs relying on the dealer's books and records of its clients' holdings and trades to meet its books and records requirements, and without maintaining its own records. And another concern is that some PMs were using the dealer's preparation and delivery of a custody statement to meet the PM's statement delivery obligations, but without the PM taking adequate steps to ensure the dealer's statements are complete and accurate and compliant with 31-103. Now, there are no specific rules governing these arrangements, despite some similarity with introducing broker carrying broker arrangements between two IIROC dealer members, which are governed by IIROC Rule 35. So CSA staff and IIROC staff formed a working group back in 2014 to try to address the identified concerns and to consider a regulatory framework. And CIPF was also consulted, as CIPF's name must be present on an IIROC dealer's account statements. So the outcome of this work is that the CSA published guidance in the notice in November of last year. The notice replaces interim guidance we published on PM account statement practices in 2013's annual summary report for dealers, advisors, and investment fund managers, which was published as OSC Staff Notice 33-742. Now, the purpose of the PMDSA notice is to address the identified concerns, add consistency and clarity for these arrangements, and provide guidance to help PMs under a PMDSA comply with their obligations in 31103, including when only the dealer sends the client statements and not also the PM. Now, I'll go over the 5 key points in the notice. First, a PM must keep its own books and records of each of its clients' investment positions and trades, such as on its own electronic portfolio management system. A PM may not rely on the dealer's records for its clients, which the PM typically has online read-only access to, as a substitute for the PM keeping its own records. This point is consistent with the PM's obligations in 31103 to maintain its own books and records, including for client investment positions and trades. A PM may not outsource its books and records maintenance to an IIROC dealer that also acts as custodian for the PM's clients, because to do so would effectively create an introducing broker carrying broker arrangement, which under IIROC rules are only permitted between 2 IIROC dealer members. Now, that being said, a PM is permitted to use information about its client's holdings and trades from the dealer's records or another service provider to create and maintain its own records. But if the PM uses information from the dealer or another service provider, it should take active steps to ensure the information is complete and accurate, such as reconciling its trade orders and investment positions against the dealer's records and following up on any differences. Second key point, we expect the PM and dealer to have a written agreement on the arrangement. We expect the agreement to cover the key terms of the arrangement and the roles and responsibilities of the PM and dealer, such as the PM is responsible for collecting KYC information like investment objectives and risk tolerance, and making suitable investment decisions for clients. And the dealer is responsible for executing, clearing, and settling trades in the client's account based on the PM's instructions and acting as custodian for the client's portfolio assets. The expectations for a written agreement are consistent with existing expectations in the companion policy to 31103 for registered firms to have written, legally binding contracts with their service providers. Now, many of the existing arrangements already have a written agreement in place. Since we've kept the agreement content expectations brief and high level, we don't expect existing written agreements as needing to be changed in most cases. Now we're on to the third key point in the notice, on disclosure to clients. So we expect PMs to provide written summary disclosure on the arrangements to clients served under the arrangement. This expectation is new, but is an extension of a PM's obligation in 31103 to provide relationship disclosure information to its clients, and is intended to help investors better understand the arrangement and what the PM and dealer's roles and duties are. We expect the disclosure in summary form and in plain language to explain the arrangement and outline the key services provided and key obligations owed by the PM and dealer to the client. For example, the disclosure could say, PM X has entered into a services arrangement with dealer Y to facilitate the management and operation of your investment account. We, as PM, provide discretionary portfolio management services and have investment suitability obligations to you. Dealer Y, a third party, holds your portfolio assets and handles cash deposits and withdrawals. They have an obligation to segregate your portfolio assets as custodian and also in their role as a dealer to execute, clear, and settle trades based on instructions from us in your custody account. Now, because this summary disclosure on PMDSAs is a new expectation, we are looking for PMs to provide this disclosure within about a year after the publication of the notice, which would be to the end of 2017. Now, the disclosure could be provided as a separate document or included with other disclosure, such as with relationship disclosure information. Now, further, in cases where a PM is not issuing its own client statements because the dealer does so, and the PM takes the appropriate steps in the notice, which I'll be getting to in a moment under key point number 5, then we expect the PM's disclosure to its clients to also inform them of this practice and state that both the PM and dealer are responsible for ensuring the information on the dealer's account statements is complete and accurate, and also provide details for contacting the PM if the client has any questions about information on the dealer's statement. And this is especially important if the PM's name and contact information is not included on the dealer's statement. Okay, on to the fourth key point in the notice, which outlines when a PM must issue its own client statements. This includes, firstly, when a PM holds any cash or investments for a client. Now, this would be rare, but may happen with a PM holding cash in a trust account or a PM holding a share certificate for an investment in a private company. Second scenario, if a client requests a statement from the PM in addition to a statement from the dealer acting as custodian. Or the third situation, if a client agreement states that the PM will issue a client statement in addition to a statement from the dealer. And if so, we expect the PM to honor the agreement unless the agreement is changed. Now, the fifth key point sets out how a PM may satisfy its client statement obligations to its clients when only the dealer sends the PM client a custody statement. As I previously stated, some PMs were not issuing their own client statements and were relying on the dealer's delivery of a custody statement, but without taking appropriate steps to ensure the dealer's statements were complete and accurate and compliant with 31103 requirements. So, to address this concern, but preserve a practice where an investor could receive one statement of their investment positions and trades instead of two statements, the notice sets out the appropriate steps we expect a PM to take to satisfy their statement obligations when only the dealer sends the client a custody statement, and the PM itself does not issue its own client statements. Now, to use this option, the PM is to take all of the following steps. First is to ensure it does not hold any of a client's assets that it manages for the client, and verifies that all are held at the dealer on a fully disclosed basis. Secondly, the PM is to confirm that a statement is sent directly to the client by the dealer with the required content and at the required frequency of 31103. They may do this by receiving and reviewing a copy of the dealer's statement or testing the preparation and delivery practices of the dealer. Although the dealer's statement requirements are set out in IIROC Dealer Member rules, these are materially harmonized with the client statement requirements in 31103. The third criteria is that the PM is to verify, such as through reconciliations of its records against the dealer's records, that the content of the dealer's statements are complete and accurate. And the PM also is to maintain evidence of these reconciliations. And the fourth criteria is that the PM is to establish written policies and procedures for ensuring it has taken the above steps initially and on a periodic basis, and documents the outcomes of the steps so it can demonstrate to CSA staff, such as during a compliance review, how it is meeting its statement obligations. So overall, an account statement from the IIROC dealer is an acceptable alternative to an additional statement from the PM, as it will include all required investment position, transaction, and disclosure information required by 31103. including the name of the party that holds the client's securities in cash and how it is held, and it will explain CIPF coverage. And of course, IIROC dealers are also registered with us and indirectly supervised by us through our oversight of IIROC. Now, I'll be talking about some other points to consider. So my discussion so far on client reporting has only dealt with quarterly client statements of investment positions and trades. But of course, PMs also have annual investment performance reporting and annual charges and other compensation reporting obligations too. Under a PMDSA, a dealer may assist a PM with the preparation and delivery of these reports, but we expect the reports to be issued under the PM firm's name and to be reviewed and approved by the PM. Under a PMDSA, a dealer will be exempt under 31103 from sending an investment performance report to the shared client, since it executes trades in a client's account only as directed by a PM, and therefore isn't responsible for the performance returns. In cases where a PM does not issue its own client statements because the dealer does, and the PM follows the steps in the notice, then we expect the PM's annual investment performance reports to use the same market value data as those used by the dealer on its client statements. This is to ensure that there is consistency in the market value information presented in the two documents and to avoid client confusion if different market values were used. And it also helps to ensure that the PM reviews the appropriateness of the market value data used by the dealer on its client statements. Here are some other points to consider. Now, many PMs send their own client statements in addition to a custody statement from the dealer, and there are benefits to doing so. For example, it allows a PM to customize the presentation of investments and trades to its clients to make it clear and easy for them to understand. And it also allows the client the opportunity to compare information between the two sets of statements to confirm the content and status of their investments. As a reminder, if a PM issues its own client statements, they are to be fully compliant with the requirements of 31103. So, for example, they must include not only investment positions, their market values and cost, but also transactions made for clients and require disclosure. So, for example, the PM just can't list investment positions on its statements and rely on the dealer's statements for transactions that the PM made for the client. Now, that being said, a PM may choose to send a consolidated statement, which groups two or more accounts together for the same client as if they were one account or portfolio. These consolidated statements are not covered by 31103. So, for example, they could just list investment positions and not also trades. But as a reminder, any consolidated statements are to be issued in addition to client statements for each account, whether they're only issued by the dealer or by both the PM and the dealer. Again, the notice only applies to PM IIROC dealer service arrangements. So, for example, they don't apply to arrangements that a PM has with a financial institution that acts as custodian for its clients. So in these cases, the PM is to prepare and issue its own client statements. Or it may apply the existing guidance on outsourcing of statements in the companion policy to 31103, which permits the production and delivery of client statements to be outsourced to a third-party service provider that acts as the PM's agent. As an example, a PM could outsource the preparation and delivery of client statements to a financial institution custodian if it meets the outsourcing expectations in the companion policy to 31103. As a reminder, the PM is responsible for ensuring the statements issued by the service provider are fully compliant with statement requirements in 31103. The key outsourcing expectations in the companion policy to 31103 for a registered firm include, firstly, them being responsible and accountable for functions outsourced to the service provider. Secondly, supervising the service provider. And third, entering into a legal binding contract with the service provider, which includes the expectations of each party. Now, parts 11 and 14 of the companion policy outline these and other outsourcing expectations. Now, here is a resources page with where to get more information on PMDSAs and outsourcing. Both are available on the OSC's website. Now, that concludes our presentation. I'd like to thank you for listening.